want to know how to analyze a multifamily deal in less than 10 minutes? I bet you're sick and tired of taking hours and hours trying to get down to the bottom of a decent multifamily deal. And if it's a good deal or a bad deal, my name is Mathew Owens. I'm a California licensed CPA and full-time real estate investor. Welcome to the Masters of Real Estate YouTube channel. I am here to tell you how to quickly analyze a multifamily deal so that you don't have to stress. You can get through them quickly and analyze more and more deals. So the very first thing you do when you're analyzing multifamilies is you look at the market rents of the property, and you're going to go through and you are going to find those comps to see what your market rents are in your area, and you're going to analyze those comps based on your square footage, your bed and bath, the same amenities as your subject building that you're trying to analyze. And you're going to look and see, what are my market rents here? And then you're going to take those market rents for every single unit and you're going to multiply them by 12 months. And that is your gross potential rent. And then immediately after you get your gross potential rent, you're going to subtract 10% for vacancy and bad debts. Maybe that's a little aggressive or a little conservative in some cases when you're dealing with really high class properties or A buildings that are occupied or that type of strategy. But I would say that it's extremely important to nail down your rents, take out that vacancy allowance to come to your gross rents. There are bad debts that occur consistently in multifamily or when you're investing in real estate. So making sure you have that bad debts allowance and vacancy allowance. I just use that 10% off the top method just as a very preliminary strategy to see if what our numbers are, to see if it's going to make sense. So the first thing we do is we take off that 10%, and then we take out a 40 to 50% expense ratio out of the net cash flows. And the 40 to 50% thing is a little subjective, dependent on the property type that you're investing in. So and dependent on the actual rents that you're dealing with as well. So if you're dealing with a $600 a month rental versus a $1,200 a month rental, your debt to income ratio, your expense ratios might be a little worse when you're dealing with a lower rental property, because property taxes and repairs and things like that can be a little higher on a per unit basis or on a lower rental basis when you're dealing with multifamily. So you're going to take off the 10% off of gross rents. You're going to take off the 40 to 50% for your expenses. And then that's going to be your net operating income. And that is your quick and dirty method to know what your net income could potentially be on a particular property. Now, obviously, you're going to back up. Once you do this initial analysis, you're going to back up every expense item. The 40 to 50% thing does not work when you're really trying to get into due diligence. You can't just take a 40% ratio and say, that's my expenses. It's not a good idea. You're going to end up losing money. You're not going to raise the money that you need for these types of deals. And so what I would suggest, taking that initial quick analysis and then dividing it by your total cost of the project. And your total cost of the project is your purchase price plus any renovation costs, plus usually 10% of interest and 10% of buffer room and things like that, and closing costs. That, just as a quick and dirty analysis of this, obviously you're going to break it down in detail if you get the property under contract or you're really interested in seeing if it's a viable deal or not. Okay. So what you're doing is you're coming up with your total cost. You're taking your net operating income, dividing it by your total cost to come up with your cap rate. Okay. And when you come up with your cap rate, say it makes $10,000 a year and your total cost is $100,000. That would be a 10 cap, or 10% on your money if you bought it all cash. So that's what your cap rate is. It's measuring your return on investment on the cost that you've paid for it if you paid all cash. Now, obviously, you're going to get some financing involved here. And what you're looking for is to make sure that your leverage makes sense. So is your interest rate 5.5%, but your cap rate only 5 once you value add it, which means that your debt stack is actually hurting your cash flow and making your cash flow become lower and lower based on that debt? Are you only cash flowing well because you have an interest only loan or one of those strategies? But the best thing to do is to make sure that you're analyzing this correctly. And the quick way to do that is that market rents for 12 months, minus that vacancy allowance, minus the expense allowance of 40 to 50% coming to your cap rate, dividing that by your overall cost on that project. And remember, you are backing into your purchase price. So you can come up with the asking price to start, then look at the renovation, see how far off you are on that, and then back down your purchase price from there to make your offers on those deals. Okay. So I hope this helped you guys. If you're looking to analyze in more detail, you obviously need to back up the property taxes. You need the new property taxes based on your basis and your purchase price, your new insurance based on your basis and what you need to cover to protect yourself, not what your seller has covered, because you don't know what their risk tolerance level is. You don't know how much they're insured for. So you can't really take their financial projections and take that as gold, right? You need to be able to really go through and analyze those key expenses. You have to make sure you put in your repairs allowance, not what's on the pro forma. Those pro formas are not true. You want to be able to go through and come up with your own numbers and your own expense estimates when you're analyzing this in detail. So you can do that quick analysis to start. And then once you get into it, if you find a deal that's really, really close that you want to start to work on and see if it makes sense, then that's when you start backing up those key numbers, pulling your detailed comps involved, actually starting the due diligence process to make sure you do all those things before you make that offer on that deal. But you can do the quick analysis to get through those deals, because you can start getting thrown tons of these things, and you really want to make sure that you can get through them quickly and efficiently. Otherwise, you'll be bogged down with analysis paralysis and trying to look at those. Now, normally when you're looking at a multifamily, you're looking at the market. You're also looking at the operators involved. If that's you, then who is your management team on the ground there? You're looking at the deal as a whole. Is it a C class, a B class, an A class building? What are the actual rental comparables of that property? What kind of preventative maintenance and CapEx do you have to spend to get that up to par, to actually get a really good cash flowing investment going for yourself? Okay. So, and what does that financing look like on the back end as well? Are you getting a 5-year term, a 7-year term? What's your interest rate? What's your amortization schedule? Who are your lenders that you're going to deal with? So there's different lenders for a property with a $2 million loan or $1 million loan than a $500,000 loan. Usually you're going to local lenders and things like that for that lower balance type loan. Sometimes you can go to different non-qualified mortgage lenders and things like that. So having all of the key pieces in place is absolutely imperative for you to be able to close that transaction, having your lending lined up, having your analysis lined up, your CapEx budget lined up, your total cost structure lined up, and where you're going to get the capital for the down payment. Is that going to be joint venture investors? Is that going to be through a syndication? Are you funding it yourself on this and doing that due diligence and doing all the homework and taking the risk yourself? So I hope this helped you guys just kind of understand a little bit about the inner workings of multifamily and how to analyze them quickly so that you can invest and be a more active investor. So I hope this helps. If you guys please like, subscribe, hit that notification bell if you guys like this video. I appreciate it and look forward to coming out with new content for you guys on a consistent basis. Talk to you soon.